Afternoon, everybody, and welcome to the final in the webinar series, the Global ABS Summer Webinar Series on payment holidays. We're just going to give it a moment before we start, just to allow some additional people to join us. Good afternoon for everyone that's joined. A warm welcome to the final in the Global ABS Summer Warm-Up Webinar Series on payment holidays. While we are waiting for some additional participants, just want to remind everyone that our panel today is open to taking questions from the audience. And a reminder on how to do that is to please go to the bottom of your screen and click on the Q&A function. Again, the Q&A button, and that's how you can submit questions to our panel. And they may choose to answer the questions throughout the panel or at the designated Q&A portion. So once again, we encourage you to, at any point you have a question for the panel, to go ahead and use your Q&A button to submit. Also, as I mentioned, this is the final webinar in the summer warm-up series. What are we warming up for? Well, that's the big event coming up this September 15th to 17th, and that is the Global ABS Conference, which has now gone virtual. Registration for this event is complimentary as a service to the industry, and you can register by visiting the AFME website and clicking on their virtual events or the IMN website, again, our upcoming virtual events. You'll find the registration links there. So with that, I am now going to turn it over to Richard Hopkin, who is the Managing Director and Head of Fixed Income Capital Markets for our event partner, AFME. Over to you, Richard.
Thank you, Jade. It's a pleasure to be here and to join this panel for the last one in our series of warm-ups, as you say, that we've been running now since mid-June, so it's gone very quickly. And the topic today is payment holidays, are the chickens now coming home to roost? When I was thinking about this panel, it seemed to me that this topic carries a certain irony. Thinking back, the last time securitization was under pressure was, of course, during the global financial crisis in 2007-8, when parts of our market, in particular subprime mortgages in the US, were accused, rightly in many cases, of seriously letting go of credit standards in a major way. And we received a tidal wave of regulation in response, especially here in Europe, as we all know. So the last 10 years, we've had pretty benign economic conditions, I suppose, and there's been strong credit performance of securitizations of all kinds, pretty much, both in the US and here in Europe. But here we are, and we're talking about the implications for securitization of credit deterioration that this time is actually caused by government intervention. You know, perhaps it's unavoidable government intervention given what's happened, but lenders are being told to lighten up on their borrowers who are falling behind on their payments. So securitization has gone from being, as some people accused us of being, the cause of the last recession, discuss, but to being potentially a victim of the current one. Anyway, enough of my philosophizing. As Jade said, we're keen to take questions, and we'll pause for questions during the process. But let's turn first of all to our polling question. We've got a polling question for people. Thank you, Jade. That has appeared in the polling section of the screen there. How serious an impact do you think payment holidays will have on European ABS? Very serious, serious, no material impact. So just focus on question number 1, please. Two questions have appeared. We're going to try and come back to question number 2 at the end. So question number 1. Whilst you're all thinking about that and hopefully voting, let me introduce our expert panel. So first of all, Olga Gekht is Senior Vice President and Manager in Moody's Structured Finance Group in London. She leads the EMEA Consumer Primary Ratings team, which assigns ratings to structured finance transactions, securitizing consumer assets in Europe, the Middle East and Africa. Jo Owens is Counsel in the Banking Regulatory team at Allen & Overy. She specializes in consumer finance with a particular focus on consumer loans, motor and asset finance, credit cards, overdrafts and mortgages. Recently, she has been very focused on payment deferrals, as you would expect, and she also advises on consumer finance regulation as part of securitization and corporate transactions. Rob Ford is one of the founding partners of TwentyFour Asset Management, where he is a portfolio manager. Well known to many of you, Rob's main responsibility is managing the firm's ABS business. He is a veteran of the markets, if I can describe him that way, who has been trading ABS since the late 1980s, and he's one of the market's leading buy-side authorities. Before joining 24AM, Rob spent over 20 years at Barclays, and he has also served as Vice Chair of AFME's Securitization Division for 5 years. And last but by no means least, we have Chun, who is the CEO of the European DataWarehouse based in Frankfurt. The European DataWarehouse is the securitization data repository of the Eurosystem and is an organization created by the market nearly 10 years ago to enhance transparency in the European structured finance market. Christian joined European DataWarehouse at the beginning of 2016, and before that he worked for 14 years at Moody's Analytics. So thank you to the panelists, welcome. Thank you for joining us today. We've got a huge set of expertise here. Well, just before I go to Olga with the first question, let's just go back to the polling and see what people thought about the polling question. Let's see the results, please. It sometimes takes a minute or two to pop up. Maybe we should come back to that. We can do that in a minute. Olga, then I will start with you. Obviously, you know, this is the topic of the moment, and I know that Moody's has published some very interesting reports recently on payment holidays. But how worried should we be? You know, should we be waking up at 5 o'clock in the morning in a cold sweat if you've got money invested in these deals? What does the data show, and how do the different countries and asset classes compare? And Christian, you know, after Olga's spoken, perhaps you can give us your perspective from the data warehouse as well. But I'll start with Olga.
Thank you, Richard. By the way, I also see that the results have now come in for the polling question, and I actually would agree, I think, with the overall conclusion. I think majority of the answers are somewhere between B and C, and my view is similar to that. I think, and I will talk about it also a little bit later in the discussion. I mean, of course, there will definitely be an impact, but the impact is not only of the payment holidays, but also of the general economic environment. And of course, the analysis, we are quite focused on the proportions of the payment holidays and the impact on the transaction. We are seeing the impact as twofold. One is the short-term impact on the liquidity, and the other is more long-term impact on the actual expected losses and defaults observed in the transactions. And I will talk about it a little bit more later, but the summary is that the majority of the transactions that we have looked at are able to withstand both of these impacts due to the sufficient liquidity available in transactions, and as well as strong credit enhancement position. But we, of course, keep a close eye on the proportion of the payment holidays in the deals. And what we are seeing right now is a great diversity of the payment holiday proportions across asset classes and jurisdictions. The main drivers that we are observing for the proportions of the payment holidays are effectively, first of all, is there a government program in effect, which requires originators and services to grant payment holidays, and also how stringent are the requirements of the eligibility for the payment holidays. So the country where we see the highest proportions of payment holidays in the transaction is the UK, and this is where we are seeing the government program in effect for payment holidays, and also we are seeing originators and services not really applying very stringent checks before granting payment holidays. So we are seeing on average about 30% of payment holidays in the UK non-conforming space, and also approximately the same proportion in the UK buy-to-let RMBS as well. In the UK prime space, the proportion is a little bit lower, but there is a significant dispersion in the payment holidays in the UK prime, from 8% to actually over 50% in some transactions. We are seeing significantly lower proportions of payment holidays in the jurisdictions where there is no government programs which are requiring payment holidays, such as, for example, Netherlands and France. In these jurisdictions, we know there are also other social support mechanisms which provide support to the borrowers who might be struggling, so outside the payment holiday. So the payment proportions payment holiday proportions which we are seeing in these jurisdictions are really not significant, in the area of 1 or 2%. And of course, Spain and Italy are also quite significant focus for us. In Spain, the data is quite difficult to obtain still. We are not seeing very clear reporting on a lot of transactions in Spain. Our estimate is that the payment holiday proportion in Spain is about 10%. And this is, of course, a lower proportion, mainly due to the fact that there is quite a stringent criteria that the borrowers need to satisfy to be eligible for the payment holidays. In Italy, we are seeing high proportion of payment holidays, in particular in the SME transactions, in the area of 30%, and sometimes reaching 50% in some transactions. And this is also driven by the government program being available for these borrowers, and also the general economic stress that we are observing in the transaction. Also, to comment on the ABS transactions, we are observing lower proportions of the payment holidays in the consumer loan ABS transactions, specifically in the area of 3 to 4%, due to smaller amounts, I think, that are payable under the consumer loans. In auto ABS, we are seeing an average of around 10%, very low proportions in the German auto ABS sector in the area of 2%, and a bit higher in the UK as well, due to the same things that I have mentioned. Also, the fact that I think originators are not applying stringent checks. So in the UK, we are seeing about 19-20% payment holidays in the auto ABS transactions.
Thank you, Olga. I mean, Christian, does that sort of is the data that you're collecting? You know, you sit on a huge amount of data at the European Data Warehouse, and I remember one of the first jobs I did at AFME many years ago when I first joined was working to help set up the Data Warehouse, and it's been extraordinary to see how the quality of information that you guys have been collecting, not just the quality but the quantity as well, has sort of grown over the years. You know, is this your picture too?
Yes, I can, and basically broadly confirm what Olga just mentioned. I mean, what we have, we have the beauty actually, we can actually dive into the actual data. So we look at a loan by loan level, and we looked at roughly 9 million auto loans, and and we looked at about 4 million, 5 million mortgages in the first and the second quarter of this year. And we try to understand actually kind of where do we see payment holiday, and often it's not reported because the templates that we're using actually weren't built for pandemic crisis. So actually we imply these payment holidays by looking at kind of are the maturities extended? Do the outstanding balance no longer move? That also gives us an idea of that there is very likely that a payment holiday is occurring in these loans, auto loans, or mortgages. And the numbers that Olga mentioned actually kind of I can broadly confirm actually kind of we see across Europe for kind of we looked at auto loans and mortgages, we see about 8% in May, June actually kind of the levels. Of course, actually kind of they differ quite significantly from country to country. As I said, as we heard, Germany actually kind of is relatively stable in terms of payment holidays. We only have 3 to 4%. Similar values also we see in Spain and France. In the UK, we see also only about 5% of the auto loans that we have, so lower than what Olga said. Italy is more than twice. It's basically 10%, close to 10%, much higher. Also there in the extension of the maturity, actually also the payment holidays are longer in Italy. They're more than 12 to 18 months, which is basically in line with the legislative moratorium, whereas the rest of Europe typically on auto loans only grants 3 months payment holidays. In the mortgage space, kind of again, very similar numbers that you kind of we see on average in Europe, roughly about 8% in June and May, June. And we see kind of very, very low numbers in Germany, very low numbers in Netherlands, and even in Belgium or France. And we see actually kind of very high numbers in the UK, in Italy, kind of where we have values of 25 to 20 to 25% in both countries. But also Portugal is around 16%, and also Ireland is about 15% of newly granted payment holidays in June. So the numbers actually are quite interesting to look into it. And as Olga also said, actually kind of we see actually a wide say dispersion of observations actually from country to country. So it seems that the national regimes actually kind of are very different depending on basically kind of how the individual countries have been affected. And of course Italy or the UK basically have been affected in a different way than the Netherlands or Germany. So we're also actually looking at arrears level, which is actually interesting. So we see a moderate increase in arrears and delinquencies in the auto space, kind of again, basically kind of they went up roughly 50–60%. So they, in some countries, again, basically they doubled, more than doubled. But it's basically on average, basically it goes from, let's say 1% to 1.6, 1.8. So nothing drastic. In the mortgage space, actually kind of it's around flat, around 1.2% delinquency rates. So nothing happening there yet. So basically kind of if we will see, I think kind of a speedy recovery economically in Europe, I think kind of that picture actually kind of hopefully will return to or remain stable. But what the future brings, nobody knows.
Thank you. We'll come back to the recovery point in a moment, perhaps, but I'd like now to turn to Rob. Rob, you know, you're investing in a lot of ABS, of course, across Europe, and you know, are you worried about what you've just heard? I mean, I saw that Moody's announced some downgrade just a few days ago, linked to the payment holidays. I mean, just to put it in context, I think there were 6 notes that were downgraded, and 28 notes were confirmed. So it was a bit of a mixed picture. But I'd be very interested to hear, what you think, because, you're at the sharp end of this. You've got money out there, and you've got, clients who are, maybe ringing you up, expressing their concern. I don't know.
Yeah, no, absolutely, Richard. And a bit like Olga, I think I fall between the serious and the less material impact buckets, and I think that depends on asset class, country, and even down to a lender type. So I think you've got to look individually, and then more importantly, probably also falls to the class levels. Those 6 tranches that were downgraded were all in the mezzanine to junior part of the capital structure. I think that other rating agencies who shan't be mentioned on this call have made comments about that they don't see any impact for at least the higher end of investment grade. Maybe creeping into triple Bs, but certainly from single A and above, they don't see any significant impact. But they have also downgraded a number of tranches in the triple B and lower kind of area. So I think you need to be a little bit on your toes in that part of the marketplace, and and consider each transaction on a deal by deal basis to really have a look at that. And you know, I think as both Christian and Olga said, probably the places where it's going, the place where it's more relevant is in the UK. The numbers around data undoubtedly higher in the UK, and RMBS is the asset class that's been the most hard hit. There's been something in autos and a little bit in credit cards, but there aren't very many credit card deals out there. So really, it's looking at mortgages, and again, in auto deals, they tend to only issue. There are a few that have full capital stacks, but they tend to issue, particularly the captive deals, they tend to issue more at the senior end of the capital structure. So less of an effect there. You know, I think in the UK, it's an interesting one because I think the payment holidays were made very easy to come by. It was a simple self-certification process, which does somewhat contradict, as you were saying at the beginning, somewhat contradicts the message that we've all had from the authorities for the last 10 and 12 years that self-certification is a really bad thing. But, you know, I think curiously, perhaps in the UK, unlike other European jurisdictions, this very easy to come by mortgage payment holiday was also offered at the same time as relatively generous income support packages. So we were offering it on both sides of the balance sheet. And I think whereas in other European countries, there were good income support packages, which meant you didn't have so many applicants down the payment holiday side, and it wasn't as easy to apply for. So I think, you know, with hindsight, perhaps we think that a lot of people have taken those holidays as a precaution. I know we're going to talk a little bit about the fallout from this a bit further down the line. But, you know, just looking at cohorts, I think in the non-bank lending space where there's a lot of concentration on self-employed borrowers, it's no surprise that we've seen much higher numbers from the non-bank sector, because the government self-employed scheme, whilst it was announced virtually alongside a day or two after the scheme for employed support, it was said at that time that it wasn't actually, no payments were going to get made for at least 2 months. And so if you knew you weren't going to earn anything for 2 months, clearly taking a payment holiday would have been much higher up your list. So I think that's why we've seen a lot of take up there, and less of it perhaps in the traditional bank and building society sectors. So, you know, we're less worried about prime. The numbers are lower anyway. In the non-prime sector, it's really deal by deal. And we're following very, very closely on how the numbers are coming out right now.
Okay, thank you. Let's sort of come back to this point about the future. I suppose the question is, you know, we are where we are at the moment, and I guess we have to, you know, I don't know what would have happened if we hadn't had payment holidays. We'd probably just have had more defaults, I guess. But do you guys think this is a long-term problem, or is it a short-term income reduction? Rob, maybe I can start with you and work backwards through the panel. Do you think this is going to get better quickly? Is it going to be a V shape? Is it going to be a U shape? Is it going to be a W, an L? You know, all these letters being used.
Exactly. Thank God we've not got a critic alphabet. I guess for me, I think the one thing that I think is undoubted is that we're going to see greater levels of arrears coming out of this. We were in a very benign environment, and we were seeing very low levels of arrears generally across most securitization markets. To be fair, the vast majority of assets that are being securitized, with the exception of non-performing loans, of course, but the vast majority of assets that were being securitized were relatively high quality, and transactions roll over relatively quickly. We're a short-dated marketplace in general, and so it's fairly easy to see arrears disappear out of pools, and they never really get a chance to grow significantly. That's probably going to change. The question is how much. They certainly are going to be bigger arrears when we get to the end. The reports that we're seeing of job losses continuously through the news on a daily basis almost are going to turn into real arrears when the holidays come to an end. You know, I think what I do think is that the policy, whether it's by governments or whether it's by the banks themselves, and perhaps led by some of the central banks as an alternative to government policy, is going to be focused more on forbearance rather than foreclosure. We've been through this process, whether it's very low numbers in parts of continental Europe whether it's medium numbers in places, some of the perhaps Italian schemes, for example, or whether it's the bigger numbers we've seen in the UK, every single authority has focused on forbearance. And once we've been through a process of 3 to 6 months worth of forbearance, it will be very, very strange if we then saw a return to immediately taking somebody who's had a 6-month payment holiday who can't carry on paying and take them straight into a foreclosure process. We're going to be looking at forbearance in the short term. And, you know, I think that forbearance in itself is really, it leads to a reduced level of income in deals, and not necessarily going to lead in the long term to losses. And for the most part, I think at an income level, that means that most deals are going to be relatively well protected. Losses will increase as well eventually, but it could take quite a long time before we start to see the results of that. Many deals may actually be coming to the point where they reach their optional maturity dates, and then issuers and sponsors are going to have the chance then to deal with that and potentially take them back onto their balance sheets, and we might never see those loans again in securitizations.
Interesting, thank you. I mean, Christian, any thoughts about whether we're in a V shape or at the beginning of a W, or?
It's very hard to say. I think if you ask basically kind of 3 economists, you get 4 answers. But if nobody knows exactly basically kind of what the future brings, I mean, just today, I think kind of Germany basically kind of published the worst kind of economic quarter ever. Kind of also did, I think the US also did it. So I don't think it's we're getting out this quickly. So I don't believe in a V-shaped economy, V-shaped recovery. I think kind of a slow kind of W shape or kind of a slow recovery, actually kind of reaching to pre-crisis levels in whatever late 2021 is probably a realistic scenario, I think kind of. So it will take some time. And as Rob correctly said, kind of, we haven't seen all the unemployment, basically kind of all the government measures actually kind of to keep people employed, etc. actually haven't run out. So actually we will see what's going to happen there. So people, unfortunately, actually kind of many will lose their jobs, and basically kind of meaning we will see higher delinquencies. We've seen higher delinquencies in March and April already, especially in countries like Italy, where they were basically kind of most affected. Not to levels that would concern me, actually. We're talking about from 0.6 to basically kind of going up to 1.6 or so. So basically kind of because we come from a very, very benign credit environment, actually, kind of where we had very, very, very low delinquency and default rates. And of course, basically, if these go up a little bit, basically kind of, or double in some cases, it's not to critical levels. But definitely kind of depends on actually kind of how we see the economic recovery. I believe that the structures in general actually kind of are built to withstand some of the stress, and most of it will. I think kind of it's up to the investors actually kind of to look very careful and closely into the individual deals actually kind of, because in some countries and some kind of structures actually kind of there might be more kind of creditors or customers actually kind of who have more trouble paying back their debt, where others actually kind of are basically kind of for whatever reason actually kind of might be better off. But yes, I don't believe that actually kind of it's not over yet. We don't see actually kind of a sharp recovery. I think it will be stretched well into 2021.
Thank you. Yeah, we've got very used to the benign economic conditions, haven't we, of the last several years? Yeah, I mean, Olga, what do you think about the is this short term or long term? Are there payment shocks down the line? You know, somebody who's had a payment holiday. You know, some of these furlough type schemes are coming to an end before too long. Are you worried that somebody they've been on a payment holiday, then suddenly they lose their job? Is that what you think's ahead of us, or is it going to be not quite as bad as that?
I think it's a very good question, and a question that we spend a lot of time on. Of course, it's very difficult in such an unprecedented situation to, predict exactly how the recovery is going to look like. I would agree, I think, with what Rob and Christian said with regards to even if it is sort of like a V-shaped recovery, it's going to be a V where the down, leg is quite fast and high, and the up leg is kind of slower and shorter. So I think it will take a long time to get back to where we were before this happened. And there is also a lot of uncertainties, as we all know, with regard to the second wave, second lockdown, which can set back, any kind of recovery that we have seen so far. In our analysis of the impact of the payment holidays, as I mentioned, we focus, of course, on the short-term liquidity impact and also on the long-term impact and the roll rates of the payment holidays to default. In terms of the short-term liquidity impacts, I think majority of the transactions are well positioned to withstand those. For example, we looked at the UK RMBS transactions, and only 10% or about 10-11% of the tranches have less than 6 months liquidity in these deals, and actually none of those tranches are AAA rated. These are all mezzanine or junior tranches, and obviously in those transactions and for those tranches, we focus specifically on the payment holiday proportion and the stress associated with those in the short term, but vast majority of the tranches can withstand this stress. Then, of course, we have to think about the long-term impact and what is the proportion of the payment holidays that would roll into default. We have done some research and analysis on the proportion of restructured loans, the loans that were restructured during the crisis, the financial crisis in Ireland and Spain, to look at what proportion of those actually would have rolled into default already. And our analysis showed that approximately 10% of loans, restructured loans in Ireland have rolled into default, and approximately 40% of restructured loans in Spain have rolled into default. So that gives us a bit of a guideline of, what we could expect. Overall, as I mentioned, I think you can expect from this crisis that we are in right now that the defaults will increase. It's just a question by how much. And for us also a significant driver is how easy it is for a borrower to obtain a payment holiday. So for the jurisdictions such as UK, where a lot of borrowers can take payment holidays opportunistically, so might not actually have as much of financial hardship as one would expect, we would expect the roll rate to be obviously lower. For the borrowers who, for the borrowers in the jurisdictions where the servicers are doing extensive checks on the eligibility of the borrower and the actual financial hardship, such as, for example, Spain and also Italy, we are expecting the roll rate to be higher because these are the borrowers who, with a higher probability, may continue experiencing financial distress after the payment holiday is over, and which would cause them to default as well. So those are some thoughts that we have around how we stress test our portfolios.
All right, thank you for that. Joe, I'm conscious that you haven't had a chance to say anything yet, so apologies. But we've been talking a little bit about the end of the tunnel, and even if we can't see any light at the end of the tunnel yet, are people beginning to think about when they might see some light at the end of the tunnel, and what kind of exit strategies are people beginning to work on? What have you seen?
Thanks, Richard. So, I mean, I think exit strategies are certainly at the forefront of everyone's mind. I think the challenge at the moment, particularly in the UK, is that the regulator has effectively across the various sectors extended the existing payment deferral guidance. So what we're seeing now is that as the original payment deferral period and guidance came to an end, we've seen the regulator effectively extend that guidance until the end of October this year. And the way that works, at least in the UK, is that customers have the opportunity to then ask for a payment deferral if they've not already had one at any point up until the 31st of October. So for those customers that take that opportunity, I think we can see these payment deferrals remain in place until the end of the year. I think that's realistic. Of course, there remains the possibility that the guidance is further reviewed again, and I understand that the FCA is proposing to put out another short consultation. We're expecting relatively quickly to start to engage on what should happen at the end of these payment deferral guidance notes. So, I mean, I think what we will see is a mixed response from customers. I think those who have come off furlough schemes and gone back to work are likely to want to resume payments. And certainly that's the regulator's stance, and they're encouraging those customers to do so. But I think we are still seeing customers who are on furlough schemes, may have lost jobs, and so who may look to take advantage to a further extension of the payment deferral, either as a full deferral or a partial deferral. And then, of course, there will be some customers, sadly, who are in financial difficulties as a result, and where lenders will then, and services will then need to look at those customers in accordance with existing rules and treat them appropriately. And I think, as Rob mentioned earlier, that's more likely to be a forbearance approach in the UK, but that's driven by the regulatory requirements, which tends to look at forbearance, first, with sort of more draconian measures as a last resort.
Thank you, Joe. Let's just check in with the Q&A and see if there are any questions from the audience. I can see one from Helen. Thank you, Helen. The question is, do you have any forecasts about what size the market could expand to, which companies and or sectors are likely to use securitization going forward? That's a slightly broad question, I think. I think perhaps that's more a factor of where we end up with in terms of the overall regulatory framework for securitization rather than what's happening on payment holidays. But I don't know if anybody's got anything to add to that.
Probably just to say, we are in general a very consumer asset focused market. We do have CMBS, of course, and one or two other corporate sectors that are smaller in general. And I think for the most part, the nature of securitizing consumer type assets, whether they're from very relatively small assets like credit cards and consumer loans, all the way up to mortgages, is probably likely to remain prevalent. The one thing that really hasn't grown, and we know that the authorities would love to see more and more and more of it, is SME securitization and help to grow SME lending across the European spectrum as part of the Capital Markets Union, and using securitization to promote the growth of that area. So I do think there's a chance that we'll see that. Of course, we need the right frameworks to be able to do that. We've had SDS come along. I know this isn't a panel about SDS, so I'm not going to talk about that as such, but it does give us a starter and a starting framework to be putting transactions into on that front. So maybe that's the one real place for growth.
Thanks, Rob. I want to come back to Joe. We've been talking a bit about the regulators. I mean, Joe, how helpful do you think the regulatory response has been on all this? We love at AFME to in a nice way, of course, complain about regulations. We try to be constructive in engaging with the regulators on them, and we try to be reasonable. But what's your perception of how the regulators have dealt with this? I mean, it seems to me that there's been quite swift responses from people like the EBA and the Bank of England. Would you share that view?
Certainly, yeah. I mean, I have to say that, as a first point, I think I've been really encouraged by the way that regulators, industry, and other stakeholders really have worked together over the past few months to deal with this unprecedented crisis. And I think in the main, the regulatory response has been helpful and has been coordinated. So we've seen the individual regulators issuing, payment deferral, payment holiday moratoria across the various jurisdictions, and we've seen then EBA responding to that from a prudential perspective and from an accounting perspective, which I think everyone would agree has been helpful. I think the challenge with any regulation, but with regulation that comes in at speed, is of course that it will have some unintended consequences and it will present its own challenges. And I think particularly in the UK, in the unique way that sort of consumer assets are regulated and the laws that they're subject to in the UK, the FCA guidance has created some headaches and some challenges for lenders and services having to implement that guidance at very short notice. And while the industry has been hugely supportive of the need to provide, these forbearance measures, I think there have been some risks that have arisen as a result of the content of the guidance and the way it's had to be implemented. And I think what's really important is, and industry certainly has been doing that in the UK, is communicating with the regulator about those challenges and getting understanding and some kind of assurance effectively that, you know, those risks aren't significant, and they have been taken on board and thought about. So I think that's been, I think it has been generally super helpful. I know that the trade associations are continuing to talk to the regulators as this situation evolves. I think we will see more guidance come out as this evolves. But hopefully industry will have an opportunity to respond. The FCA has been pretty good about having consultations, albeit short consultations, but has given the industry an opportunity to respond to the proposals that they've made.
Very good. Rob, perhaps I can come to you and then come back to Joe in a second. I mean, in terms of what's happening in practice, what have you seen in terms of implementing, you know, the guidance that Joe's been talking about? Do you feel you're getting enough information?
I think it's varied significantly from issuer type. Again, probably. I think most regulated lenders, particularly here in the UK, have pretty much fallen into line with the guidelines. You know, almost rolled over to a certain extent. I don't want to say that as an accusation, but very much taking the guidelines on board, particularly under the self-certification that was brought in very, very quickly at the beginning. You know, maybe with hindsight, they might think again about how that was done, and the second time around, when payment holiday extensions were brought along, banks and lenders were allowed to collect more information and to ask some more searching questions at that point in time, and were actually advised that it was in the best interests of customers that they should start paying again if they could, and that they should pass that advice to those customers. So I think maybe it was introduced in a hurry, and a lot of people fell into line very, very quickly. And not surprising that the banks and the building societies were going to do that. They're at the forefront, and the biggest lenders, of course. It probably had a bit more of a negative effect on the non-bank lending sector. A lot of the non-banks that are regulated, still regulated by the FCA, found themselves forced to follow these guidelines. But of course, they didn't get the benefit of the central bank funding schemes that were also introduced, like the TFS here in the UK, or TLTROs, and even the special ones that have been introduced across Europe, which I can't remember what they're all called, Feltros and other stuff, but didn't get the benefit of those. And you know, there's less of a non-bank lending culture in mainland Europe, a little bit in Holland, but less so elsewhere. But without that benefit, some of those lenders were left struggling entirely, and in fact, many of them have been forced to either stop lending, not quite shut down their businesses yet, but that might happen if we're seeing shops and restaurants and other businesses being forced to close. There's every likelihood that we might see some mortgage lenders forced to close at some point. But I do think that they've certainly been forced to shut down lending significantly, to rein back in on the scope of lending that they do. We saw LTV levels being reduced dramatically. Pretty much 75 became the maximum LTV that you could get, which clearly is not a great benefit for consumers and for borrowers going forward. So it was implemented in quite a hurry. I'm not sure that was it was fully thought through, but it was done in such a way that it was designed to protect the consumer as much as possible. The longer term ramifications perhaps weren't thought about. I do think that more recently, having had that extra opportunity to go back and talk to borrowers and tell borrowers that they have that it's in their best interest to start paying again, we have seen a very strong number. It's very early days, because we've only really got to the point where the very first cohort of people who took out their initial 3-month initial 3-month holidays, come to the end of that period and been asked to start paying again this month. So most of those numbers haven't been published. There were some numbers from UK Finance yesterday, which were quite interesting, which said, or the most recent publication from them, which they update, I think, weekly, which said that they now think that owner-occupied mortgages in the UK have fallen, payment holidays have fallen from 1.5 million to 800,000 in the last 2 to 3 weeks. And I think buy-to-let, much smaller overall quantum, but from something like 250, 260,000 to 140,000. So really good numbers. The numbers have come down very quickly in that first cohort, and that's encouraging. What, of course, will be interesting to see, A, does that carry on, and B, what does that rump look like as we were talking about arrears earlier on.
Okay, that's all good. We've got another question from the audience. David Vingren, regarding the Moody's downgrades, how much was RMBS? Any other asset classes? Olga, would you like to perhaps take that one?
Yes, of course. Yes, so with the UK RMBS transactions, we have downgraded 6 tranches in 4 UK RMBS transactions. All of these transactions are in the non-conforming space, UK non-conforming RMBS, and all of these transactions have actually been closed in the last 3 years. So the main risk with this transaction was the fact that they did not really build up sufficient credit enhancement to withstand the additional stresses that we were expecting to arise in these transactions from the payment holiday proportions, but also from the deterioration in the general economic environment in the UK. I have to emphasize this is really a small proportion of the UK RMBS market, so we really try to take a quite measured approach and take into account all aspects of the transactions, as well as long-term nature of the assets in the RMBS transactions. So this is, yes, this is with regards to the UK RMBS. We do have a handful of transactions in some other asset classes on review, literally 1 or 2 transactions in the consumer ABS or auto ABS space, which we have put on the review. And this was also driven by the expectation of the deterioration in the economic environment. And we are still going through the stress testing of those transactions as well.
Okay, that's great. Thank you. I'm just keeping an eye on the time. We've just gone past the 45-minute point, so we need to sort of think about wrapping up. I don't want to finish, though, without giving a little plug to a piece of work that AFME did recently. We've recently published a couple of days ago to our website some best practices for investor reporting for payment holidays. So if anybody's interested in taking a look at those, please go to the AFME website and have a look. The idea behind them was to try and bring some consistency to what was reported in terms of payment holidays, because I think there's been a little bit of frustration from the investor community about, you know, a lot of information coming out in lots of different types of formats, and it's quite hard to compare. So we've tried to suggest some voluntary uniformity there. I mean, Joe, I don't know if you think that sort of thing is helpful from where you sit.
I do think any kind of consistency of information has to be helpful and beneficial, so that people are sort of comparing like with like. You know, we chatted at the start of this around some of the difficulties in reading the initial data because the payment holidays weren't reported as payment holidays as such. So I think anything that we can do to kind of alleviate those types of issues and make it easier to see what the data is showing would be helpful.
Great, thank you. Let's go to our second polling question. This is now up on the screen. And this sort of comes back a little bit to my introductory remarks. Stresses caused by payment holidays will be the first real credit test for European securitization since STS was implemented, actually since a long time, probably. Regulators and policymakers will be watching closely, I'm sure they will. So the question is, will securitization emerge with its reputation enhanced, damaged? It depends on how the deals perform, or it depends on how the industry responds. So please have a go at expressing your opinion on that. And perhaps I'll come to Christian and ask him to share his thoughts on that question with us personally.
Personally, I believe that actually kind of I would give it a C. I think it's very much basically kind of deal dependent. I don't think actually kind of that the entire industry actually kind of will be taking into responsibility like we've seen back in 2008, 2009. As you said, at the beginning actually kind of with the financial crisis. Will the securitization industry basically kind of, or the instrument financial securitization actually emerge with an enhanced reputation? I doubt it. No, I don't think so, but it will not be damaged either. I don't think actually kind of that securitization basically kind of will be the new rising star of financial instruments. it is a very, very good financial instrument, and it basically and properly structured and fairly and well understood. Actually, kind of it does exactly what it should do: diversify risk and basically provide opportunity to invest. So I think kind of as I agree with your view, actually, kind of securitization as a financial instrument has been misunderstood in the last decade. Kind of we go from mainly basically because how it was portrayed in the media, and so that basically kind of, I don't think actually kind of the securitization industry will be damaged. I don't think it will be enhanced. Basically kind of, I think it really basically one has to look on a deal by deal level to understand basically what's happening. We've just heard from Olga, from Joe, from Rob, kind of that is really kind of key. It's key to understand basically kind of how certain industries, how certain countries, how certain jurisdictions perform. What are the regimes kind of protecting some of the borrowers and where certain kind of schemes expire. So I think kind of that's it. And I think will the kind of every patient depends on the industry. I think the industry is trying its level best. I think kind of the industry definitely has learned its lessons from the financial crisis. AFME, of course, is the prime example for it. But I think it's just basically trying to everybody's trying to do the right thing. I think STS still has a number of shortcomings. I think the high level forum report, I think kind of clearly raised those. But I think kind of the industry in the last 10 years definitely kind of it's done its bit, actually kind of to kind of work on the reputation of securitization as an instrument. And I strongly believe it's a fantastic instrument, basically kind of if understood properly. So in this case, and this current crisis we're focusing, it's not the cause of it's not caused by the securitization industry or the instruments, but they are exposed to it. They suffer from it. So as an investor, actually, kind of you need to understand where you put your money. That's basically why you have to really kind of focus kind of on the data that's available, understand the regulatory environment, understand the economy, and basically kind of listen to the rating agencies and basically kind of get as much information as you can. Or basically kind of, it's just basically my kind of 1 penny of thoughts. So
not worth more than 1 penny, I think.
Richard, could I just perhaps have one tiny thing
Sure,
to that? I very much agree with much of what Christian said there, but I do think on the enhanced point, which is what I voted, by the way, I do think that we are still in a position where there are a number of naysayers, particularly in the regulatory, not so much regulatory maybe, but the policymaker and politician, political camps, who still believe that, have a very negative view of securitization and still believe that it's the devil's instrument. And I do think that there is a good opportunity here that if we come through this relatively unscathed, which means it does depend on how the deals perform, but if we do come through this relatively unscathed, that we will have more armory in our pockets to be able to say how well we've performed through this crisis as well, and prove to them that what we've put in place in terms of restructuring securitization over the last few years has done what it said it would do, and that they should trust us again, and that we are not a toxic marketplace.
Sure. So if we were a ship, we've been sailing through very calm waters for the last several years, haven't we? So we should expect, some bad weather, which has arrived. But if we come through it without taking on too much water, we should hopefully be better performed. Then we can say to the authorities, look, these deals by and large have performed as expected. The credit enhancement has done its job, blah, blah. Good. Let's just take a look at the results, which are just in. Yes, as ever, the audience is a cautious bunch. Mostly it depends. But there's a reasonable strand of thought that thinks, this could, in the long term, turn out to our advantage, I think, because it will be an interesting test. Any concluding remarks from Joe and from Olga? Perhaps, Joe, you could go first.
No, I mean, I think for me, it's very much a wait and see in terms of where we are over the next few months and what happens. I think there's so much uncertainty just within the nature of the pandemic itself and how that's going to evolve. And, we're seeing different spikes in different countries and different countries responding to those spikes in different ways. So for me, there's still a huge amount of uncertainty. And while I would like to think that come the end of October, we would go back to business as usual from a regulatory perspective, and customers would be, resuming payments, I think a lot of that really remains to be seen.
Indeed. Olga, any last remarks?
Yes, I think for me it was actually D. I think it's important to see how the industry responds in terms of the disclosure and the clarity of the information, because it is quite clear that, of course, it is a crisis. We will see some deterioration in performance, but how the industry reports this performance and the payment holiday proportions, how clear this reporting is, so that the market can respond in a timely manner. I think this is what will really decide the future views on securitizations as a result of this crisis. I think the work that AFME has done and attempting to standardize the reporting, I think, is very, very valuable. As I mentioned before, we have seen some differences in the reporting, which are difficult sometimes to reconcile. And I think most industry participants are experiencing these challenges. And I think going forward, it's going to be very important to make sure that the reporting is clear so the market can respond appropriately.
Great. Well, thank you very much for that. I think we probably have to leave it there. We've still got a good crowd on. So thank you all who've dialed in for listening and for joining. A big thank you to all of my panelists as well. Thank you very much for sharing your insights. It's been a really interesting discussion. And thank you to our partners at IMN for helping with all the organization and the infrastructure. And we look forward to seeing you all again for virtual Global ABS on September the 15th. Until then, have a lovely summer. Goodbye.
Thanks, Richard.
Thank you.
Thank you. Bye-bye.
Thank you. Bye-bye.
Bye.